So name of this reading is Understanding Fixed Income Risk and Return. First LOS is sources of return from investing into a bond. So these sources of return sources of cash flow, we would divide into three parts. Can you tell me what is the first one? The coupon that you receive every year. Then face value or market value when you sell the bond, and reinvestment of coupon. So these are your three sources of return when you invest into a bond. Now we can do an example to understand this. Sources of return, the coupon, face value or market value, and reinvestment of coupon. Let us say we have a bond with face value of 1000, coupon rate of 10%, maturity of 10 years. So let's say we decide we need one more variable, YTM at issuance, let us say 12%. So we decide to invest or purchase this bond. Can you find out what is the amount we will have to invest at time 0? 886.99. So in case if you want to know how to do this, future value would be 1000, payment would be 100, N on the TVM row would be 10, IY would be 12, and then we will say compute present value. All of you getting this number? Now, once you invest 886.99, then every year, year 1, 2, up to year 10, every year you will receive a cash flow of 100. And by the end of year 10, you'd receive 100 plus 1000. Now let us say this investor decides that as and when he receives this 100 and 100, he will keep on reinvesting them. Now one inherent assumption with YTM is, we know that YTM and IRR is the same concept, and we assume that yes, that interim cash flows would also be reinvested at YTM. So this 100, the first 100 would be reinvested for how many years? It would be reinvested for 9 years. The second 100 would be reinvested for 8 years. So in this fashion, the investor kept on reinvesting all the cash flows. So by the end of year 10, now the total amount that he's going to have, first he's going to take that face value of 1000, plus he must have received 10 coupon payments. So total 10 coupon payments would be another 1000, plus because he's reinvesting that coupon, he will get to earn some reinvestment income. This reinvestment income we can calculate using the payment function on the calculator. So let's do it together. Second clear TVM, 100 payment. It's a simple annuity, 100 payment, 10N, 12 IY, compute future value, 1754. Now this 1754, which is a future value, includes also the principal invested, which is 1000, right? 100, 110 payments, which means the reinvestment income in this case is the 754. So total cash flow that this investor will have by the end of year 10 would be 2754. So what's happening with this investor? At time 0, he invested 886.99. At time 10, the total amount he will have with him is 2754. Using this data, we can calculate what is the realized yield of the investor. And how do you do that? Second clear TVM, 886.99 negative present value, 886.99 negative present value, 2754 future value, This is happening over a period of 10 years. So 10 would be N. And then we will say compute IY. And this IY should be, ignoring decimals, it should be precisely 12%. That means if investor actually gets to reinvest at the YTM, then his realized yield and YTM is going to be same. Is that clear to you? So you can write down these points here. This part is done writing. Please write fast. So I'm building a small summary table here. Don't write as of now. I'm going to make some mistakes in this. You have to identify which one. So assumption for this table is that holding period of the investor is same as the bond maturity. Which means if the bond is of 10 years, then the investor is going to hold on to the bond for entire 10 years. First scenario is that reinvestment rate is same as YTM. If reinvestment rate is same as YTM, then realized yield is going to be same as YTM. Correct or incorrect? Correct. Second scenario, reinvestment rate is greater than YTM. In this scenario, realized yield is going to be greater than YTM. Do you agree? And in the third scenario, reinvestment rate is less than YTM and realized yield is going to be less than YTM. Now to completely understand the first learning outcome, which is sources of return from investing into a bond, we will also have to understand the second learning outcome. So we will move on to the LOS-B and then we will go back to LOS-A. So second LOS, first heading you can give is Macaulay's duration. Macaulay's duration. And subheading you can give is bond stripping. Now all of you understand what is a zero coupon bond. So zero coupon bond is you pay some X amount today and let's say maturity is 5 years. For those 5 years you would not receive any cash flow and then after 5 years you would receive a lump sum amount. So from an investor perspective, it's kind of a fascinating concept because a lot of people invest based on what are their goals. So let's say that you have a goal that 5 years from now you would want to purchase a residential property. Now 5 years from now, if you want to purchase a residential property, let's say of $2 million, then you can invest some X amount now in such a way that in 5 years it will get you that amount. Which means what zero coupon bonds do for investors is it helps them assign a particular investment for particular objectives or particular goals. And therefore zero coupon bonds all over the world are extremely popular. But in US, one difficulty is that US Treasury issues only one zero coupon bond and that is a Treasury bill. Is Treasury bill a zero coupon instrument? Yes, Treasury bill is a zero coupon instrument and the maximum maturity which is available for Treasury bill is 1 year. Correct? So now what if I am an investor in US and I want to invest into a 5-year Treasury bond? It will not be available because US Treasury does not issue it. And that's where there was a gap in the market and this gap is filled by the dealers in the bond market by using the process of stripping a bond. So let's see how does it work. Let us say we have a Treasury bond. Face value of this bond is 1000, coupon rate 10%, maturity, I'm just making it up, hypothetical, 4 years. We have 4 spot rates, year 1, year 2, year 3, year 4. First year is 7%, second year, I'm intentionally going to keep the gap larger, 12%, third year 15%, and fourth year 20%. Can you value this bond? So we know that valuation of this bond would simply be present value at respective spot rates. What are the cash flows we have here? 100, 100 and 1000. The first cash flow we will discount using the first year spot rate So 1 plus 7% raised to 1. 1 plus 12% raised to 2. 1 plus 15% raised to 3. 1 plus 20% raised to 4. And the last one, 1 plus 20% raised to 4 again. And I want the breakup individually in terms of value of each of the cash flow. How much is the first one? 93.45. Second one? 70? 79.71. 65.75. No, individually. Individual values. 48.22 and 482.2. And now add up all these numbers. Add up all the four present values. 69.5. Fair enough. So I'm just rounding it off. 769.5. 69.50. Are we together up to this? Now, let us say you're a dealer in the bond market. You go to the US Treasury or US Fed and you purchase these bonds. So to purchase the bond, what is the amount you're going to pay? 769.50. Then you go to the investor. So there are, let us say, 5 separate investors that we have. You go to the investor and this first investor needs a 1-year zero coupon bond. Now, if he is going to invest for 1 year zero coupon bond, how much should he expect to earn? If you're an investor in this scenario and you want to invest for 1 year, how much in percentage term should you be expecting to earn? 7%, because that's the 1 year spot rate. So let us say if there is a zero coupon bond with face value of 100, to earn 7%, what should be the issue price of that bond? Are you following my question? There is a zero coupon bond, face value 100. The market price should be 93.45. So what this dealer will do him, he will ask him to pay 93.45. That means this investor will pay to the dealer 93.45. And in return, he will receive a zero coupon bond with maturity of 1 year. In the same fashion, second investor will receive a 2-year zero coupon bond. Now, if you're investing for 2 years, how much should you expect to earn? 12%. Third investor will receive a 3-year zero coupon bond. Fourth investor, 4-year zero coupon bond. And fifth investor, 4-year zero coupon bond. So what dealer essentially did, he purchased a regular coupon bond and he converted that into 5 separate zero coupon bonds. Let's think from the perspective of investor number 3. Investor number 3 will find out what is the 3-year spot rate. A 3-year spot rate is 15%. Then if he wants to purchase a zero coupon bond with a face value of 100, he will simply do this calculation. 100 divided by 1.15 raised to 3, and he would find out that market price of this bond would be 65.75. So he will go to the bond dealer, he will pay him 65.75, and after 3 years he will expect to receive how much? 100. And from where will this dealer pay 100 to him? From the coupon that is received from original treasury bond. So in 3 years, dealer is going to receive this cash flow. He will simply take this 100 and give it to the third investor. Are you following this? So in this fashion, dealer will collect a total of 796.50 from all the 5 investors, and he will take this money, he will go to the government or US Fed, he will purchase this treasury bond, and then he will assign each of the cash flow to each of the investor. This process is called bond stripping. The first 4 zero coupon bonds, these 4 zero coupon bonds here, these are called as the coupon strips. And the last one here, principal step, because it is made out of the cash flows from principal. Now the most common question people have with this is, why is dealer doing this? What is the benefit that dealer is deriving out of this process? So what dealer will do is, instead of selling the bond at 93.45, he might sell the bond maybe at 93 or let's say 94. This bond he might sell for 81. This bond he would sell for 67. So in this fashion, instead of receiving 679 from the investor, he might receive, let us say, 775. And that's how, by doing this entire process, he will get to earn a spread of about $5 to $10 on a 100,000 or 1,000 investment. Are we clear here? Write down quickly then. Yes, have you understood this? Should I clear off the screen? Now see, this concept is very essential for your understanding of bond markets, because what we are essentially learning here is, and listen to this statement carefully, if you are buying a 4-year coupon bond, that 4-year coupon bond is actually a portfolio of 5 separate zero coupon bonds. Do you agree with this? So any coupon bond that you purchase, you are essentially purchasing a portfolio of zero coupon bonds. And once you understand this, then your way of thinking about bond market is going to change completely, because everything that follows after this is dependent on this particular sentence. So write down this sentence now. A coupon bond is essentially a portfolio of multiple zero coupon bonds. A coupon bond essentially is a portfolio of multiple zero coupon bonds. Are we fine with this? So let's do one more example now. Let us say face value 1000, coupon 15%, maturity 4 years, and we have spot rate of year 1, 2, 3 and 4. Spot rate of year 1, 2, 3, 4, 10, 15, 20% and 25%. Okay, so I want you to solve this in a particular fashion. Just hold on for a minute. You have to make a table. So first you will say, first column in your table would be maturity. So it would be year 1, year 2, year 3, year 4. Second column would be cash flows. So cash flow in year 1 is going to be 150. Year 2 would be 150. Year 3, 150. And year 4, 1150. The third column would be discounted cash flows. And you will have to solve for each of the discounted cash flows. And keep space for 2 separate columns here. We are going to use them for some other purpose. So keep space for 2 columns and start solving for discounted cash flow. And give me a total of these. Total as well as individuals. Yes, so first DCF is 136.36. Second one 113.42. Fourth one, third one 86.80. Fourth one 471.04. Total 0.63. All of you got this? Now see, what I am saying here is, you have purchased a coupon bond with maturity of 4 years and 15% coupon rate. But I am saying instead, you have purchased 4 separate zero coupon bonds. The first bond has a maturity of 1 year and face value of 150. Second bond 150, third bond 150, fourth bond face value 1150. Do you agree? So total value of your portfolio is how much right now? 807.63. Now your portfolio is made of bonds with different maturity and different amounts. Some bonds have maturity of 1 year, 2 year, some of them have 3 year, some of them have 4 year. If I ask you a question that what is the average maturity of your bond portfolio? Average maturity of bond portfolio. What kind of average will you calculate? You would want to calculate a weighted average. So step number 1, you would be required to calculate weight. And how would you calculate weights? You will say total amount invested in my bond portfolio is 807.63. In the first bond, how much amount you've invested today? 136. So 136.36 divided by 807.63. So the weight in the first bond is, so I'm going to round it off, it's 16.88, I'm saying simply 17%. Second bond weight would be 113.42 divided by 807.63, 14.04. So let's say 14%. So that's 11%. And that would be 58%. So we have a total of 100%. Have you understood how weights are calculated? And then we can calculate a weighted average. And see how are we doing it now. Please observe. 1 year maturity. We have how much weight? 17%. So 1 into 17%, this is going to be 0.17. 2 year maturity, we have invested 14%. So 2 into 14%, this is 0.28. 3 into 11%, this is going to be 0.33. And 4 into 58%, this is going to be 2.04. 2.32, and then we will take a total of all these numbers: 0.17, 0.28, 0.33, 2.32, 3.1. So this 3.10 is essentially the average maturity of your bond portfolio. Are you following this? That on an average, your money is being invested for how many years? So about 17% of the amount was invested for 1 year, 14% for 2 years, 11% for 3 years, and 58% for 4 years. So on an average, on a weighted average basis, your amount is being invested for 3.1 years. And this 3.1 is also called as Macaulay's duration. Okay, so Macaulay's duration is nothing but simply a weighted average maturity of bond portfolio. Do you want to ask any questions here? Yeah, what is the significance of this number? For that, we will have to go to LOS A again. So for the timing, we will keep this on hold. But just understand what is Macaulay's duration. Macaulay, because it was Macaulay who came up with this calculation. And duration is essentially a measure of risk of a bond portfolio. But in case of Macaulay's duration, there are different types of duration. So in case of Macaulay's duration, you simply want to read this number as the average maturity of your bond portfolio. That's it. So if you invest into a 4-year bond, we know that a 4-year bond is nothing but multiple zero coupon bonds with different maturity. So on an average, what is the maturity of the entire portfolio? That is 3.10 years. That's it. Are we good here? Will you be able to calculate this?
Can I skip one
if you want to purchase just the 2-year 0 coupon bond, you go to a dealer, he would charge you some extra amount. So he will not sell you at 113, he might sell you at 115. So you buy it from him and you're done. Yes. But if you purchase one entire bond, you purchase one entire coupon bond, then you're essentially purchasing, in this case, 4 0 coupon bonds. We can either say 4 or 5, it's the same thing. Right? Either we can show them separately or we show them combined. Are we fine here? You solve a couple of questions on this. Next one. Let us say we have face value as 1000, coupon rate as 0%. Which bond? 0 coupon bond. Maturity of 4 years and 4 year spot rate of year 4 is 12%. Find out Macaulay's duration. So maturity, I am building the same table. Maturity year 1, year 2, year 3, year 4. Cash flow 0, 0, 0 and 1000. Discounted cash flow 0, 0, 0. How much is this? 635. This is calculated as 1000 divided by 1.12 raised to 4. 1000 divided by 1.12 raised to 4. Then we will calculate weights. So of course the bond value is 635. Then we will calculate weights 0, 0, 0 and entire 100%. And then a weighted average. So 1 into 0, 0, 2 into 0, 0, 3 into 0, 0, 4 into 100%, 4. And therefore, your Macaulay's duration is going to be 4. So write down a sentence. For a 0 coupon bond, Macaulay's duration will be same as, that is equal to bond maturity. However, for a fixed coupon bond, Macaulay's duration, what do you think? Less or higher? It would be lesser. It will always be lesser than bond maturity. Are you fine here?